Woo! It's been a while, and there's tons of world events going on. We want to cover something very important in this lesson today, and that is how to actually order a stock. Well, not really. So, in this lesson, what we're going to be focusing on is the price of the stock, what the different prices of the stock mean, and how you can actually go ahead and place orders. This will be the first in a series of a few parts that'll give you the depth of what all of this means to help you successfully order and purchase your first or third or 100th stock. So it does seem as easy as hitting a buy button, but it's really not. Purchasing a stock actually involves a little bit of a deeper thinking than just saying, oh, I want to buy this stock. Because there's so many things that go into the price of a stock, which we'll highlight in just a few moments. Snack on this. Know your orders and stock mechanics, part 1. To start, there are two major types of orders that you should know about. But before we get into that, let's go into what the price of a stock actually is. Well, it's simple, right? The price of a stock is the stock price that you see on your screen, right? There's a little more that goes into that. There are two types of prices displayed when you go to buy a typical stock: the bid price and the ask price. A bid price for the stock is the highest a buyer is willing to pay to purchase that share or that company or that stock, right? It's you as the buyer, what you want to bid at the highest possible level for that stock. The ask price for a stock is the lowest amount that a seller is willing to accept for a share. So it's you selling the stock, but hey, you don't want to sell it at the current price. You want to sell it slightly above the current price, maybe 2x its value, 5x its value, whatever that may be. The ask price is the lowest amount that you are asking for that you will be content with in selling the stock. And all you have to do is place your order, put the limit at your ask when you go to sell it, and the market will figure out the rest. You don't need to do anything else regarding that. And we'll get into the mechanics of that in a later episode. But for the purpose of this, the bid is the highest a buyer is willing to pay. The ask is the lowest amount the seller is willing to accept for that share. In liquid or fast-moving stocks, these prices tend to fluctuate. So you'll see rapid movement between these stocks. You'll see rapid movement between the prices, and the bid and ask price will only be a couple pennies different because it's a liquid stock. In slower moving stocks, however, the bid and ask price can be two very different prices. You can see spreads, and what I mean between the spread is the difference between the bid and the ask. So just to reiterate that, the spread is the difference between the bid and the ask price. I've seen spreads that'll be $10, $20, $30 because the price doesn't move as much. So the bid, or the highest a buyer is willing to pay, is $20 less than what the seller is willing to accept for that particular share. Sure, the transaction may or may not get executed at that price of either one, but I'm sure that there is a seller that feeds into the buyer or a buyer that feeds into the seller. So the price can be different at any point in time, depending on the stock, depending on the liquidity of the stock, on what you see the spread is between the bid and the ask, right? The way this translates to for the stock price is the stock price is the transaction at which the stock filled its price at the last time, okay? So what this translates into is here's the bid, here's the ask, but the stock price that you see displayed on your screen as the current price of the stock is the price that was last transacted at. Was the buyer and the seller came to an agreement, and boom, it's displayed on your screen for you to easily access or see what happened with that. Let's get into the mechanics here, right? It sounds simple enough, but we'll solidify it with an example. Let's take Microsoft for an example, okay? The price at the time of this episode, or writing this episode, $212.66. That is what the price of Microsoft was, aka the price of the last transaction of Microsoft occurred at $212.66. Now, the bid for this stock at this point in time was sitting at $212.55. On the flip side, the ask price for this stock was sitting at $212.69. So you see there was a 14-cent difference in the bid price versus the ask price, but the stock was sitting more towards the ask price. Why is that? Let's explain it. There are folks who submit orders all day long as a market order. A market order means that you're executing that transaction at the price that the lowest ask is available for. And this thing happens very lightning fast, very quickly. So that's why you see such discrepancies between the bid and the ask price, because the price is fluctuating so much throughout the whole ordeal. So the fact that the price is sitting at $212.66 versus the 55 cents or the 69 cents, that means that a transaction occurred, a market transaction occurred between that where the ask price was at $212.66 or the buy price was at $212.66. The transaction met somebody else's credentials, and boom, there you have it. The stock was sold and bought by somebody at $212.66. Does that make sense? This is what we call, again, a market order. A market order says this, is, hey, I'm not concerned about a few pennies here or there because I just want this stock in my portfolio. So I'm going to just buy it at a certain price and hold it for the long term and let it go above whatever price that I bought it for from the ask price. Now, your ask may get filled at a higher ask if you do this market order because it's just looking to fill your order at that point. That's why we recommend limit orders. We will get into limit orders in the next episode. This episode is more to give you what the bid, the ask, market, and how that sort of mechanic works. Sometimes market orders will execute above the ask price, as I just said. Because the ask was so high, the exchange that you're on, the brokerage that you're on, just sought to make that transaction. So you paid a little bit more for that particular stock. So you'll see a loss right away of a few bucks. But again, for the long term, if you hold for the long term, that's where sort of the appreciation aspect of it shines. People use the bid and the ask price more to sort of control their entry points and exit points when it comes to stocks. If they want particular percentages, if they're working with very, very large sums of cash, where that 10 cents does translate into tens of thousands or hundreds of thousands or millions of dollars, bid and ask prices are important for that mechanic to occur, right? For that mechanism to function properly and for you to get the best value of your money. The 14-cent price difference that we're talking about just now adds up when you're looking at 1 million shares or when you're looking at 2 million shares to buy for your portfolio. But when you're looking at 10, 20 shares, it's not going to matter all that much in the long-term perspective. So the key takeaways here for the stock market price mechanics is the bid price is the buyer telling the market that this is the highest I am willing to pay for this particular stock. The ask price is the lowest amount that the seller is willing to accept for their share of that particular stock. And the market price is essentially the transaction that was executed last for that stock, okay? Again, in the example of Microsoft was at 212.65-ish or so because that was the last price the transaction executed, even though the bid price were so different, the ask price was so different. That's where you get the price of the stock. It will sit in between typically of the bid and the ask. So just keep that in mind next time you go to place a stock order. We'll dive a little deeper into the different types of orders in our next episode. But for now, during this week, take a look at any stock. Microsoft is a great example of a stock that you can look at where you can see the fluctuation. Go to Yahoo Finance, type in MSFT, which is the ticker of Microsoft. Look at the bid and ask prices and the difference between them and how the stock sort of sits between them, the orders, the quantity, the volume that the transaction is occurring on, and keep investing.